So, you've probably heard this term thrown around, right? Bear market. It always seems to pop up when the financial news gets a little gloomy. And yeah, it sounds kind of intimidating, but what if I told you that really getting this one concept is a massive step towards feeling way more in control of your finances? Let's break it down.
Yeah, it's everywhere when markets get shaky, usually attached to some pretty dramatic headlines. So, what does it actually mean for your investments, your savings, or, your future? Well, it all kicks off with one simple number.
There it is. It all starts with minus 20%. This is the simple technical trigger. So when a major market index like the S&P 500, which you can think of as a scorecard for 500 of the biggest US companies, drops 20% or more from its recent high, bam, we are officially in a bear market.
But here's the thing, that 20% drop, it's just the starting gun. The real story of a bear market goes so much deeper than just one number. It's about psychology, really. It's about the collective feeling of everyone in the market.
See, it's really a two-headed beast. You've got the price drop, sure, that's part one, but it's also combined with this feeling of pessimism. It's a general belief that things are probably going to get worse before they get better. It's when confidence just takes a nosedive and fear starts making the decisions for people.
Now listen up, because this might be the most important thing to remember through all of this. When you're stuck in the middle of a downturn, man, it can feel like it's going to last forever. But history is crystal clear on this. Markets move in cycles. Bear markets are just a phase, and they have always been followed by a recovery. Since World War II, the average bear market lasted about 14 months, but the average bull market that came after, over 4 years long.
So what kicks these things off anyway? Usually it's a major event that really shakes that investor confidence we were just talking about. It could be a big economic recession, or maybe runaway inflation that's squeezing companies, or central banks jacking up interest rates. Sometimes it's a huge geopolitical crisis that just creates a ton of uncertainty. All right, let's clear something up. You've probably heard a bunch of other terms thrown around during these times, and it's super easy to get them all jumbled. So let's get specific, because knowing the difference between a bear market, a correction, and a recession is actually really important. This table breaks it down perfectly. A correction? That's a smaller, more common dip, about 10%. A bear market is that deeper, scarier, 20% drop. Now notice how both of those are about asset prices, the stock market. A recession, on the other hand, is totally different. That's about the health of the whole economy, measured by things like GDP. Now, they often happen at the same time, but they are not the same thing. And this brings us to what I think is the most fascinating part of a bear market, the human element. Honestly, it's driven just as much by emotion and psychology as it is by any economic report. This is where you see that classic snowball effect. One person gets spooked and sells, pushing prices down a little. Well, that makes more people nervous, so they sell, and on it goes. This wave of fear can actually become a self-fulfilling prophecy, dragging asset prices way below what the companies behind them are even worth. But here's the flip side. While some people see fear, other people see something else entirely. For long-term investors who can keep their emotions in check, all that widespread panic creates some incredible opportunities. I mean, think about it. When everyone else is frantically selling, quality assets can basically go on sale.
Okay, so we know they happen, we know what drives them. The big question is, how do we actually prepare for them and navigate the storm? Let's get into some practical, smart strategies that investors use to not just survive, but sometimes even come out ahead in a bear market. First up, diversify. It's the oldest advice in the book for a reason. Don't put all your eggs in one basket. Simple. Second, something called dollar cost averaging. This just means you invest a set amount of money regularly, say every month. When prices are low, that fixed amount of cash automatically buys you more shares. It's brilliant. And finally, maybe the most crucial one, avoid panic selling. Your emotions are the enemy of a good long-term plan. Selling at the bottom just locks in your losses for real. And hey, these principles aren't just for the stock market. They actually become even more critical in really volatile markets. Take the world of crypto. Their bear markets are called crypto winters. And trust me, the price drops can be way, way more extreme. But the core strategy? It's exactly the same. Think long-term and refuse to give in to panic. So let's bring it all home. The big takeaway is this. Bear markets aren't some weird fluke. They are a normal, predictable part of the financial cycle. They've happened before, and they will absolutely happen again. So the question isn't if the next one is coming, it's when.
And now that you know how they work, the only real question left is, will you be ready for it?